Welcome to Fides Wealth Strategies Group Financial Moment with Dr. Chris Rand and Mark Gallo. Our efforts here today are to talk to you a little bit about asset allocation. It's an ever increasingly robust topic these days, and I think it's important that we discuss how it affects you, where it's important, where you should be considering it in your life. What's probably the biggest reason why people like asset allocation?
Well, lately I think they might not like it quite as much because the last number of months the fixed income market just hasn't been doing quite as well as the domestic equity markets have been. But the main reason people like it is that it's a way to reduce your overall risk. And so if you hear as an example that the stock market went up 10%, and you're in a 60-40 portfolio, 60% in stocks, 40% in bonds, what you're really saying is that 60% of your portfolio went up that 10%. And then the other 40% did whatever the bond market did, right?
Assuming you're in S&P 500.
Assuming it's if we're using the S&P as the measuring point, I guess, if you want to say that. The opposite is true as well. Let's say the S&P 500 drops 10% and you're in a 60-40 portfolio, your portfolio would be down roughly that 6%, right? 60% of that 10%. And then hopefully if you're investing in bonds for the rest, and hopefully they did well, maybe it's not quite down to 6, it's down 5 or 4. So it's a risk reduction strategy, I would say.
Back in the good old days, the bonds were getting a great rate of return, and so if the stock market came down, the bonds would help lift it up, and it was a really good offset. Now, I always like to equate it to driving a boat with an anchor hanging off the back. It just slows you down a little bit, but you can stop a lot faster.
Yeah, and especially when it comes to, a lot of volatility like we've seen, really over the last number of years. We've seen time periods where we've got this volatility where the stock market goes up a lot, the stock market goes down a lot, and those that are in a well-diversified asset-allocated portfolio don't see those big swings up and those big swings down. Behavioral finance is something that's become very much of a topic over the last number of years, and everybody likes it when their portfolio is going up. Love to see statements going up, love to see the statement balances going up. 2021 was a good example of a time period where things were going really well, and then suddenly we had a pullback. I think it was the third quarter, if I'm not mistaken, right? And you'll hear from clients, "Whoa, what happened? Why were statements a little lower than they were in the past?" It was really the first time that we had a quarter where we saw a negative pullback in the market.
March of 2001.
Yeah, well, that was a year prior,
or 2020.
Right? But over the previous couple quarters, they'd been relatively good performance, and then a pullback. And so behaviorally, I wouldn't say anyone I talked to was really concerned, but they had noticed. And the notice was not the same when the market was doing as well. So there's this academic theory called loss aversion theory, which leads to that. People are loss averse. They are more concerned about losing money than they are about making money.
Absolutely.
And so asset allocation in general and that diversification is a good way to address that behavioral component, which at the end of the day, you just don't want to sell when the market's down.
Yeah, I mean, traditionally you want to maintain, when we talk about asset allocation, we're really going to talk about things like the 4 major asset classes. You've got cash, you've got stocks, bonds, and real estate. Mm-hmm. So, whenever you look at a portfolio, it should be comprised of all of those. Now, if you don't own real estate inside of your IRA, you probably own real estate personally, so that's going to help offset it. Very seldom periods of time in history have we seen all 4 asset classes go down.
At the same time.
It only kind of makes me think about 2008 in those scenarios.
Yeah, that was a rough one.
That was a rough one. But, during that time period, that's where everything lost money. But the reality is, the comeback has been, equally as strong, if not stronger.
However, I would argue that asset allocation still did work in that time period where the bond market was not down as much. Right. The real estate market was not down as much.
Cash wasn't down as much.
Cash wasn't.
Remember, we lost money because of Lehman Brothers.
Yeah. Well, hopefully you weren't investing in them, but there was a real talk about, for the first time in a very long time, is cash going to lose money? Right. Are money market mutual funds going to? They call it breaking the buck, meaning that the $1 NAV dropped, and there were a couple cases. There were to 99 cents or 98 cents, and so but But to your point, you didn't lose as much.
Right. Yeah. Of course. Which again goes right into the behavioral finance component that most people, when they invest, as long as it's so funny. Whenever I look at statements and you go, okay, I got one that's green. Okay, I'm not doing too bad. When you look at a red. Oh, I got one that's green. Okay, good. Now, what you have to do is avoid the natural instinct as an investor to then move all of your money into the green one, thinking that, oh, well, they got that figured out. That's an actual perfect time to be able to rebalance your portfolio and reallocate it according to who you are as an investor.
Yeah, because otherwise they're chasing returns, right?
Absolutely. And and it's always important to understand and always come back to who you are as an investor. I think that is absolutely imperative. If the market's been rallying for 20 years, it doesn't mean that you should be more aggressive. It's if you're a moderate investor, then you should be a moderate investor, a 60-40, maybe a 50-50. And so that's where you're going to watch things there.
Well, let's talk about the 5 basic risk profiles briefly.
Absolutely, yeah, absolutely. When you talk about the 5 basic risk profiles, you go with a conservative model, right? And that's going to be your traditional 80% into bonds, 20% into equities. You ramp it up a little bit more, conservative to moderate. That person's going to be maybe 60% bonds, 40% equities. A traditional model for moderate is going to be either 50-50 bond stocks or maybe 60-40 bond stocks. Or stocks bonds.
Stocks bonds.
Yeah. And then going to a moderate aggressive, you're going to be looking at more like 75-25 is generally where we start to see that kind of really step in. And then and more an aggressive investor is going to be anywhere between 90 to 100% equities.
Yeah.
And that's what you'll start to see.
I like to think of it as 1 to 5.
Yeah.
1's conservative, 5's aggressive. When you go to the doctor's office and the nurse says, how bad does it hurt, 1 to 10. I like to think of equities and risk the same way. How bad could it hurt when you go through a really, really negative equity market or a bad stock market? A 5, it's going to hurt a lot.
Yeah.
1, it's going to hurt the least amount.
Yeah, how do you feel? I hear a lot of times people talk about, well, I'm going to be more conservative now that I'm retired. You hear a lot of people like to talk about that. Now, personally, I'm not a big believer in that kind of conversation. I personally believe if you're comfortable with, being a moderate investor, then you should be a moderate investor. You shouldn't go off of where you're at in the stage of life. People feel like, oh gosh, if I lose money, I'll never have a chance to gain it back again. But also understand, that doesn't mean you should rush all into cash. A lot of times it means, great, well, we have a need for this for 30 plus years as a retiree. Chances are really good, the market's not going to be down for 30 straight years.
Well, at the end of the day, it's all about your propensity for risk, how much are you willing to take, your time horizon, and then your goals, to your point.
Absolutely.
You may be 65 or 70 or even 80 years old, and your goal for your money is to deliver it through an inheritance to your beneficiaries, which could be decades away, and you're comfortable with risk. Your time horizon is 20, 30 years. Maybe that's okay to be more aggressive.
Yeah.
We have other people who get into retirement and they just say, I just want to stay the same pace. I want to keep pace with inflation. I don't want to go backwards. We hear that a lot. And so what they're really saying is we're interested in a portfolio that gives us a real rate of return of just slightly over 0, right? So we just barely beat inflation. And then there's everything in between. Although I think that most retired people, generally speaking, we hear this all the time, just want to take less risk because their time horizon is shorter.
Yeah.
Their need for the money is now, and their need, the time period that they're going to use it over is a shorter period.
I always like to reinforce the idea at the end of the day is that, if you're in a 60-40 portfolio, 60% equity, 40% bonds, that 40% bonds should represent probably anywhere between really 5, maybe 10 years of your income. And so that way, if you feel like the market's not going to be there 12 or 15 years from now, well, then you probably shouldn't be investing as aggressively. So,
and as we wrap this, this moment up, maybe that's a good topic for the future. Is how do we generate an income portfolio when somebody is retired? Because A, you need to generate income, but B, and probably just as important as that income needs to keep pace with inflation.
It needs to keep pace with inflation.
Inflation's a big concern lately.
Absolutely. Well, thank you very much for joining us with the Fides Wealth Strategies Group Financial Moment. We'll talk to you again soon.